my name is Celeste Sierra, and today we're going to be talking about PPM, term sheet, and due diligence. So PPM stands for Private Placement Memorandum, and this happens when a company decides to make an offer of their securities to select investors. These select investors can be angel investors, private investors, and venture capitalists. So if a company didn't want to open themselves up to the public to raise, let's just say $10 million, that would be the quickest and fastest way to do it. They would lose a lot of their power offering that stock to the public. So what they'll do, instead of going through that method on Wall Street and hiring brokers and underwriters and having additional expenses like such as that, they'll find these investors to help raise the $10 million, and they'll offer them some sort of security in exchange, usually a preferred stock, not really a common stock. So what is in the private placement memorandum? It's the terms of entry, requirements by the investor, disclaimer and discloses matters related to the business and its equity. So it really spreads everything out, the good, the bad, the ugly. It's very, very open and honest to whoever is reading it, interested in investing. Both accredited and unaccredited investors are welcome, with limitations depending on the rule, whether it's 504, 505, or 506. They can have up to 35 non-accredited investors, but they must have $1 million in assets, not including their home and car, and have an income of about $200,000 or more. So the purpose of a PPM is mostly for project funding of startup firms and for more risky ventures that have a harder time opening themselves up to the public to get this capital. So they were once highly regulated and required by the SEC, but in 1992, there were many revisions made, and it made PPMs much more lenient. So some of the cons, they're not regulated by the SEC. That could be both a pro and a con. Most trades don't perform as promised. They can be extremely hard to determine if the program is real and what is not real. Only about 1% of them are real, which is why you do your due diligence, which we'll talk about in a little bit. And it can also take $1 million to apply. Some of the pros are that businesses save on broker and underwriter costs. They can produce higher yields than you can ever expect from investing. And very high net worth individuals can profit privately and protect their identity, which they wouldn't be able to do if they were investing in a public stock. And the possibility of becoming connected with the most influential people in the world is very high when you're involved in PPMs. So there are 7 parts of a PPM. It's the investor's notice, the executive summary, overview and purpose, terms and conditions, which is the most important, risk factors, financial statements, and the use of proceeds. So it's kind of like a business plan, but different. Just kind of like in how it's sectioned out. And we'll talk about the most important part, which is the terms and conditions. The term sheet, terms and conditions, it's called a few things. We're going to call it a term sheet. Also has its own parts. So this is the most important part, meat and potatoes of the whole PPM. So it starts with the valuation, the securities being issued, who they're being issued to, the price they're being issued at, what kind of securities, the board of rights, the rights that the business or company has once they issue these shares, investor protections, the handling of the shares, and then there are miscellaneous provisions. And when you are going over the term sheet for both the investor and the company, negotiate. That is how you're going to make this deal and have both people or have the investor sign and agree to it, is by negotiating what the investor wants and what the company wants, and then coming to some sort of agreement. And once that's all said and done, you'll move on to your due diligence. So this literally means required carefulness. Failure to do due diligence is a huge risk and potentially a failed investment. It's just doing the right thing, right? Going over it, making sure there's one, standard reasonableness behind the PPM, and that the information holds materiality. So accredited, non-accredited, and responsible investors perform due diligence themselves and with a diligence committee, such as an attorney or an accountant. And once it's reviewed and satisfied, the PPM is signed and the deal is done. So the term sheet was non-binding, but once there's due diligence done, negotiations done, everything's agreed upon, it's a done deal. Thank you.